Now we can shift gears a bit and look at the refined products and really what's happening on a demand level, what's happening in terms of, where is that demand going to come from, and then what does the storage picture really look like. So we always like to start with this chart just to look at what is that rolling average, where do we sit in terms of the last few years, because in some of the other charts we're going to look at going back to the early 1990s, where do we sit on a historic level? But this is just looking at things over the last 5 years. And you can see we still remain well off peak, and we're starting to flatten out and just kind of roll over just as we start to get towards that seasonal slow period. As you can see with 2019, 2018, 2017 averages, you start to see that decline as we go into October. And we don't see anything, we're not seeing anything that really change that view and where we're going to go over time. So when we look at this, we have to appreciate, okay, well, what does this mean for margin? What does this mean for crack spreads? And again, we're going to see continued weight on just where a lot of this product can actually go. So we always like to start off with distillate just because distillate it remains the most oversupplied at the moment with the highest storage levels and just a limited exit point. And, here we had a draw of about 1.68 million barrels. And you can see we're still at this elevated level. And we should start to see these draws accelerate in October and November as you get a demand for heating oil, you get a demand for different shifts. This is something where, again, we keep talking about those different weights where shipping remains a little bit of an overhang, trucking is getting better, and rail had some nice data points, which we're going to talk about in a minute. But this is where we continue to see the bigger issue. And with the export market really kind of shutting down in terms of some of this opportunity, or at least getting more competitive on a pricing level, it's going to be hard to see some of this product really exit and free up space. And that's why when you look at just where do we have the biggest overhang, it remains pad 1 and pad 3, not only on just year over year, but over the 5-year average. And pad 3 just doesn't have that export capacity that they have in the past to try to get rid of some of this excess volume, which is going to be a problem when you consider, well, where are you going to put some of this product? How are you going to, change the crude slates? And that's something that we're talking about when we look at refinery utilization rates, what the headwinds are going to be, because you inherently make diesel with most, if not all, of your processes, and that's going to be an inherent issue. That's why we've seen alkylation units, some of the other hydro skimmers, things that are really kind of avoid some of this diesel cut or distillate cut that is starting to come in just to get away from, and you're starting to see some coking capacity, some other FCCs come down just because to avoid and to address this specific issue. And that's when we go to the product supplied. Again, there's not going to be any real surge that's going to absorb a lot of this. And that's one of the issues that we continue to see, which is why we remain pretty confident that we're going to come back down to that 5-year average, or I should say the average as we go back over the last 29, 30 years. And there's really nothing to change that because, again, those dueling headwinds, headwinds versus tailwinds remain in the market. Now, we keep showing the rail side. The rail side has gotten better. And there's two things that are going to keep that in a positive light. One is we're getting into harvest season, which is going to be good because we're seeing a lot of demand for grain. We're seeing a lot of exports start to increase on the agricultural side, and that's being reflected here when we look at farm products, when we look at grain. And then when we go a little bit bigger, when we start to talk about on the economy show, intermodal's also starting to pick up a bit, which is a good thing to see. You're starting to see a little bit more movement within the U.S. Things are starting to normalize. We're still 12% down year over year. But again, if you remember, we were down 15, 16, 18% year over year. Now, year to date, still down 16%. But again, some of that is going to soften a bit as we do see an increase on the agricultural side and we start to see a little bit more movement on the intermodal side. These are things that will start to draw a little bit more diesel, which is going to be a nice benefit. But again, shipping is starting to roll over a little bit. So again, shipping is going to remain kind of that headwind as we go forward. But with a little bit of better data in rail traffic, we continue to see a surge in trucking traffic. And this is another, again, big component for that market demand. And we can see that we've gone from, I think last week it was at about 91 on the demand index, and we're now at 98.5. So you can just get an idea that We continue to see trucking really take a lot of market share, starting to see additional flow. And we added something at the bottom, and it's that yellow line, which is called the truck availability, because as we see these rates continue to drift higher, again, diesel prices remain low, so these rates are going to be driven by demand and based on the shortages, and you're starting to see that. And here, that demand is starting to dwindle down, which is going to be nice because that means that the spot market rates, which have continued to go up, you haven't seen the same kind of pull in contractual rates. But now, as these contracts start to roll, you're going to start to see that contract rate also shift higher as the demand is, as the availability is absorbed, and you're seeing that in the rates as the rates continue higher. One of the ones that we always like to look at is that refrigeration, just because you're moving a lot of food instead of so these vehicles are in high demand. As you can see, that they've now really kind of taken over, and you're starting to see a little bit of a normalization in some of these others, but the refrigeration trucks remain paramount in terms of where this is now. How does this change as we go forward? We think you're going to start to see a little bit of a rollover as we go into September. But again, it's not going to be on the same level. Like if you go to 2018, you can see the big spike, then the drop off. We think there will be a drop off, but just because of the continued demand, the continued shortages at the manufacturing side, and when we're looking at inventories, those are things that are going to keep these trucks moving, and we're just not going to see the same kind of correction. We will see a movement lower, but again, this will be a nice demand spot for road diesel, which will help offset some of the softness that's come into the shipping market after seeing a nice pickup really through the July and into the first part of August. Now, when we look at gasoline and just shifting gears here, we have to consider, what were the draws, what happened. So obviously gasoline had a big draw. It was really driven based on PADD 3, which had the draw of 2.9, which came to an aggregate draw of about 4.3 million barrels. We're coming back down. We're still not quite there. We're still at seasonally adjusted all-time highs. But again, this is something that is continuing to normalize a bit. But what happens when you get draws? You start to get price increases. And if we saw on PADD 1, which is the East Coast, we saw some price appreciation. And what does that do? That attracts imports. So here you can see we saw a little bit of an increase in imports, but that's only going to accelerate over the remainder of September. Now, there's a timing delay, obviously, because there's a sailing distance between, you have to come across the Atlantic. That's going to take time, but by the end of September, we're going to see a lot of cargoes really start to hit into PADD 1, and just because of that timing delay. But the ARB opened, and it opened in a big way, which allowed some of this gasoline to flow from Europe into the U.S. markets, and it's just going to show up over time. Now, we should have one more big pull in terms of gasoline, and then we're going to start to see this normalize as we head deeper into shoulder season, which again comes down to the mobility issue and how we continue to see some of these headwinds as people really aren't driving at the same level. Now, here's a little bit of a different chart looking at, because we talked about imports coming in from Europe. Well, what's happening on a global level when we start to factor in all of this data on TomTom and other types of mobility? And here you can see the U.S. is really flattened out, which is what we've really been talking about. And we think it's going to accelerate, not because of COVID, but just because of the seasonal shifts that we've seen on a normal aggregate basis. And you can see that if we go back to January, again, and this is looking at just where the slowdowns continue to accelerate. The bigger issues remains in Europe. Europe, we have France, Italy, a lot of these areas that continue to remain sluggish, which again allows more exports into the market, which is why you're seeing an increase in the amount of imports coming from Europe, just because there's more available. We're also getting commentary that you're seeing an increase in extended downtime throughout the European refining complex, which is also going to be, really is reflective of the problems that we're seeing on just the total demand levels. Spain's something similar. So here you can see, just when we aggregate all this together to get you to the G20 index, you can see that we're still seeing those problems with very little kind of upward mobility here, especially as we go through and into a tough period of time. And that really comes back down to the gasoline supply. Again, last week we talked about timing delays, that we're going to see this drop off. And here you're starting to see that drop off. And we think it's going to continue to drift lower after, what we're expecting to be a little bit of a bump either this week or next week, just given on when, how Labor Day looks. We don't think Labor Day is going to be overly exciting, just because you did have a storm, you still have damage. You have people that may be looking at things a little bit differently, which we'll talk about in the economy show on jobs and job security, which may keep people home for the Labor Day weekend, which will weigh on some of those normal shifts. But as we go out into September, into October, we believe that you're going to continue to drift lower along higher than what is seasonally expected, just given the lack of mobility within the U.S. And then jet fuel, we've talked about jet fuel demand really kind of coming off. We continue to see additional layoffs, additional airlines starting to cut some flights that have been added. And it's just because we're not seeing the demand pick up. But it's important to understand that we normally see a drop off in this time. So the question is, how is it happening in relation to what has happened in the past? And that's why we look at the TSA data. And when we look at the TSA data, you can see that we had that drop off. You start to kind of roll over as you go through August into September. And we continue to hold between that 525 to, let's say, about 700,000 passengers. And there's really nothing to show that that's going to change. And typically you get a drop off into September, and then you start to see an increase in business travel as people end their summer vacations, start to get a bit more mobile. And we just don't see that happening. So we continue to see what these headwinds, specifically in the U.S., but again, it's also reverberating throughout the rest of the world, just because tourism is going to be a problem. You're just not seeing travel the same way within the States as well as abroad. So this is going to be a bigger headwind. And again, not to look at this chart too much, just because you can see there's been no change. If you look at the 7-day average, we continue, which again is being reflected in that mobility index, is being when we're looking at the gasoline demand, the driving demand, you can see that we remain well below average. And the problem is that workplace side of things, because typically you would want to see that start to turn higher as we go into September. And we just don't think people are going to be going to work in the same way. And we're seeing that. Again, this is the data. And then anecdotally, I'm sure everyone has their stories. We continue to have friends, family that keep saying like, look, I'm not going back. My company doesn't want me back. Or the office is open, but even when I go in for a call or a meeting, it's maybe 15% filled. And I think you're starting to see that. And as the parks start to come down, as it starts to get a little bit colder, again, you're going to see additional headwinds on some of these mobility indexes. And the one benefit that we have seen is, again, open table. We're starting to see a little bit more activity when we're looking at restaurants. And it's really twofold. One, we have a lot of COVID cases coming down, specifically in the U.S. and some other areas. So people are feeling a little bit better going out. It's been beautiful out, so the ability to sit outdoors and be comfortable has increased. And what do you feel comfortable being indoors? So maybe this is the last kind of hurrah that you can get to a restaurant before you feel maybe uncomfortable, because you're like, all right, I'll sit on the patio, but I really still don't feel comfortable sitting in a bar or sitting inside. So that's where you're starting to see some of this, where we think you can see a little bit of an increase, as we go through the remainder, the last few weeks. Now, if you look at the open table data, again, on a global level, things are getting better. We're starting to see that some consistency within Canada, Germany. The U.S. has definitely seen a nice uptick. The U.K. was an interesting one. So we actually had one of our viewers reach out and showed us something that was pushed out. The UK government was helping specific restaurants that had signed up. And then you can get discounts, you can get different benefits for eating out to help support local restaurants. So that was actually why you saw that big jump in August, because it was going through August. Not sure if it's been extended, but I think it was supposed to expire as of August. So that's why you do see that drop off. But again, we're also talking about August 31st into September 1st. So it's also a matter of weekend dining versus weekday dining. So those are things to consider. But again, so that'll start to weigh a little bit on the with the UK coming in. But again, the data continues to be supportive as we look on an aggregate in terms of people getting out, spending a little bit more money. Again, it's the question is going to be, how do people feel, or how is spending going to continue as we go into the fall and winter months, when you really don't have the ability to sit outdoors and it's either in dining or takeout. And again, that's going to be a matter of how much mobility, what are people doing? Are they driving there? What is the food demand? Because again, this is part of the supply chain. This is part of the diesel movement, the refrigerated trucks. These are things that all really kind of culminate with what is demand going to look like, and we continue to see headwinds within the U.S. And in our next segment, we're going to shift a little bit, and we're going to go looking at the export market and to see how things look in terms of the U.S. products hitting the international, the global markets.